Hello and welcome to Insure Wealth. I'm Michelle Suskauer, and today we have a very special program for you. In this next half hour, you're going to find out a lot about what you need to know as you plan for your loved ones, your favorite charities, your own security, and peace of mind. And to lead us through this very special program is our expert, insurance advisor Howard Kaye. Howard, welcome back.
Well, thank you, Michelle. It's going to be an exciting and I believe a very valuable program for our viewers today.
Now, Howard, let's get right to it.
All right, first, let me make it clear. I am not a financial advisor or a planner or giving you tax or legal advice. What I do know and can talk about is life insurance and how it can help you build wealth for your family, your loved ones, your favorite charities. Most people think that they buy a life insurance policy and their families get a death benefit, and that's it. But as part of a diversified portfolio, life insurance can be much more than that. It can help you to maximize your wealth. It can be a valuable asset as something that we call the investment alternative. You see, we can't call life insurance an investment, but a tremendous alternative it is. It can help you maximize your IRA or any retirement plans that you may have. It can benefit your favorite charities tremendously, and it can have substantial tax advantages.
Now, I know there are different types of life insurance. What are the different advantages of them?
Well, before getting into some detail, let me start with a few definitions. There is term life insurance, and this is insurance in its most basic sense. It's there to protect you and your family in case you die. When I say in case you die, we are all going to die one day. But when you're young, starting a family, you've just gotten married, you buy term insurance to make sure that, God forbid, you predecease everyone in the family, there is money so that the family can continue to survive. But remember, that is for death benefit purposes only for a specific period of time. Another example of that would be key man life insurance, meaning you are in business with another person or a number of people, and your company would suffer tremendously if one of those partners were to pass away. In this case, you buy a term insurance policy, in my opinion, to help cover or mitigate those problems if one of those partners should pass away so that the firm has money to sustain itself. Remember, the coverage period is what dictates the policy. If you pass away during that coverage period, your beneficiary gets the face amount of the policy. If you live past the term of the policy, your coverage ends, and you or your family or your partners will get nothing back. So there are options if that takes place. You can always look to convert a policy for a new universal life policy without regard to your health. So God forbid your health changes while you've had this first policy. Look to see if there's what they call a term conversion. And if there is, you don't have to be, or you do not have to reprove your health. You will just continue that amount of coverage if that's what you elect, and obviously the premium will be higher because the policy is now going to last for a longer duration into your 80s, 90s, or even 100s if you choose to do that.
Okay, that's basic. What's whole life policy?
Whole life insurance is a type of permanent insurance, is really what we call it. It includes a cash value, and it provides coverage for your entire life. So with traditional whole life insurance, the cash value can potentially grow up to, or what we say in this case, it would endow upon age 100, meaning the cash value would grow to equal your death benefit at age 100. Now, there are many advantages to whole life insurance, such as the cash values can be used as collateral to borrow from the bank or from whatever financial institution. You have a structure in this policy. If you find that you are looking for a more cost-effective policy, you are able to utilize the funds through a surrender, or what we've discussed in previous shows as a 1035 tax-free exchange, and move into another type of policy that can substantially reduce the cost. So a whole life policy is not to have the most cost-effective policy, but it allows you to have certain features such as very high cash values, the ability to borrow against the policy, to use it in a corporate setting, And typically, people use it as a younger person, so when they get older, they can utilize some of that money for retirement purposes. Again, the money that's in that policy is always accessible if you ever want to surrender that policy.
Then I read and I hear about what's called universal life insurance. What is that?
Yes, universal life is another form of permanent insurance. Although in this example, it gives you much more flexibility. If you heard me describing whole life policies, there's a structure to whole life, and it's very difficult to stray from that structure. What universal life does is gives you this permanent protection. And when we say permanent, just so you understand, it means that it can last a lifetime if that's what you desire. But you have the ability to structure it any which way you want. What does that mean? Well, it's all about flexibility. So you buy a stated amount of death benefit. You can choose how much premium you want to pay each year. What do I mean by that? Well, there will be a stated premium in order for the policy to last forever. But if you tell me that you want the policy to last through your age of 90, there will be a lesser premium charged. Why? Because the policy will be worthless after age 90. You can even reduce your premium to a greater extent if you went down to age 85 or 80. But one very important message. You might ask, why would anyone do this if they're not going to have coverage after that initial duration? The answer is, you are buying a contract that lasts forever, essentially. What determines its longevity is the amount of money you put in. So you may pay a reduced premium for a number of years, and as you see your policy is going to end in a shorter period of time, you have the ability, without going through new underwriting or anything, to simply add money to the policy to extend its life.
Now, I've heard you talk about being able to give away your estate twice. So what does that mean, give away your estate twice? How can you actually do that?
Well, that's a great question, and this is one of our strategies that we've developed over the years. And I'll tell you, in fact, we've been in business for approximately 50 years now, over 50 years. Wow. That was started by my father, and I've been in this industry for the past 30 years. So let's get into this first one. How do we give our estate away twice? Well, it's been said that charity begins at home. Now, that may not be true, or it may be true, depending upon who you are. But as far as the way I see it, it doesn't have to end there. You can give your estate away twice, once for the benefit of your loved ones, and once for your favorite charity. Now, that is a lot better than reducing your assets to pay the least income and estate taxes. In effect, you can quadruple what you end up leaving behind.
Can you explain that, please?
Let me give you an example. This was a couple, 72 years of age. The husband and the wife was 67 years old. What they were looking to do was leave money to a university, actually. And when they went to discuss what the gift would be upon their death, they realized that they would not have left anything for their children. And that was not what they wanted to have happen. What they wanted to do was to leave money to the university, but at the same time leave money to their kids. So what was discussed was how to take their estate, which was approximately $10 million, and leave 100% of it to the university, and at the same time leave that same $10 million to their children. How was this accomplished? Well, back then, when this discussion was taking place, the lifetime exemptions were $1 million each. So what that meant was both the husband and wife could use their exemption, and what that meant was they could each transfer $1 million to an irrevocable life insurance trust. So that's what they did. There is now $2 million sitting in that trust. The trust bought a $10 million second to die life insurance policy. Now, that was a one-payment policy, no additional premiums based on the current interest and assumptions and mortality charges at the time. No other money was needed. When they both pass away, that trust will receive proceeds in the amount of $10 million that is completely tax-free. Now, what happens with the rest of their money? Well, remember, they were worth $10 million. When they gave away $2 million to this trust for the benefit of their kids to purchase a $10 million life insurance policy, they were left with $8 million. Now, I will tell you, in discussions with this couple, the first concern is, can we afford to move $2 million? You see, these were bond purchasers, and they told me that they were making at the time 6% on their money. Well, that meant on $10 million, that's $600,000 a year. But when I asked, what do you spend each year to maintain your lifestyle, the answer was $72,000. So clearly, they had plenty of income. Now, their concern was if they took principal away from them, it would eliminate the income that they need. But let's face it, whether they have 10 million or 8 million left, 480,000 is the income that the 8 million creates, and that's more than enough to accommodate their $72,000 of living expenses. So what's the bottom line here? The $8 million left in their estate would certainly grow because they're not using all their income. And by the time they pass away, the estate might be at 10, 12, or $15 million for all we know. Whatever it is, the $10 million that's in the trust, irrevocable life insurance trust, that was created as a result of the life insurance policy going into that trust, that will go to the children, completely tax-free. The money that was left in their estate, which was $8 million, but now it may have grown to 10, 12, or 15 for all we know, where is that money going to go? That is going to go to the university that they promised. And at the end of the day, what took place? They gave their estate away twice. 100% went to their kids, and approximately 100 or more went to their favorite charity.
So you can give your estate away twice.
Absolutely.
That's pretty amazing. Now, for more information, 561-417-5883 or online, insurewealthtv.com. Now, Howard, I've heard you can say life insurance can make a big difference in someone's financial success, and that life insurance can be an asset and an investment alternative. So what do you mean?
Well, it's really a lot easier than you might think. By utilizing an irrevocable life insurance trust, you can save up to 90% on your estate tax costs.
90%?
Absolutely.
Okay.
Now, this is really how the industry and business for estate planning purposes with life insurance really began many, many years ago. We used to discuss discounting estate tax cost up to 90%. How could that be? Now, these numbers are based on the time many, many years ago,
right,
but the theory, the concept is what should stick. So how does this work? Well, let's assume you had a $10 million estate. The estate taxes in those days would have been approximately $5 million. So if you did nothing, the $10 million would go to the kids, and the kids would owe $5 million to Uncle Sam. But by structuring an irrevocable life insurance trust, two people in those days were able to transfer $500,000 in order to buy this $5 million policy. Now, this was a couple age 60 at the time. And back then, they got a 10-to-1 return for the insurance benefit. A last-die policy owned by this irrevocable life insurance trust in the amount of $5 million. Purchased with what? With the $500,000 that they gave to the trust. Now, after they both pass away, the trust will have the proceeds to basically pay the estate taxes due on the estate. Now, I'm simplifying it because what's going to happen is the trust will have the cash. The cash will be then used to purchase assets from the estate so that there is cash in the estate to pay the estate tax. But the bottom line in this case is you will have paid $500,000, not $5 million, and your family receives that total estate. So if $500,000 is what you paid, I guess that's 10% of the $5 million tax bill. That was a 90% discount on your estate tax costs.
It absolutely is. So you're saying life insurance should be part of a diversified portfolio along with stocks and bonds, real estate, and other investments.
Absolutely. And speaking of stocks, in my opinion, because I am not a registered investment advisor, but they go up, they go down, and they're sideways. And when financial markets are in turmoil, and we've all experienced that in our lifetime, a lot of people with substantial means see their net worth slide and go down. Well, if you've lost money in the stock market or any other program, you can help recover those losses for the ultimate benefit of your family or charity.
Now, I've never heard that before, that you can recover losses for your family's benefit. So how do you do that?
Well, this is philosophically speaking. I will say this, that many people who are in this position of having substantial assets and don't need the money to maintain their lifestyle, but they still like to invest their money and see it grow. When they lose money, the first thought is, how do I rationalize this? I want to be able to think in terms of, well, it's not going to affect me at all, but I feel terrible that I lost.
Right.
But who's really going to suffer? It's the children or the grandchildren's money. So it makes someone feel better, like it's not affecting me. So the kids will get a little bit less. But inside, they're still kicking themselves that they let themselves lose that money, or they went into a program that wasn't a good program.
Okay.
So what we show is, or what we discuss with people, is how to recover monies through life insurance when you never thought of it in that way. So here's how it works. If you lost, let's say, $2 million in the stock market, buy a $2 million life insurance policy. If you lost $3 million, you buy a $3 million policy. But by using only the money you do not need for living expenses, this is your extra, your surplus, monies that you don't need, you can replace that hard-earned money that you lost in the market and pass it on to your families and charities. So again, I know it's so simple, but did you ever think about it? Did you ever think that I just lost $5 million in the market? I want that money back. It's not going to affect the way I live, but it's going to affect my children and grandchildren, or it's going to affect the charity that I love so much. But there is a way, and I'm sorry it's so simple, but look into purchasing a life insurance policy in the amount of money that you lost.
It actually is. It is. Sounds very simple. It is simple. Now, but let's talk about something else. Most of us have IRAs. Now, we know that we have to begin to take money out of them when we hit 70 and a half, and then we have to pay income taxes on those withdrawals. So what can we do to maximize our IRAs?
Well, listen, after building a sizable IRA through the years of hard work, you may find that you don't need the mandatory distribution. That's what we all plan for, but you don't need that money to maintain your lifestyle. So again, I say to all of you, you've reached 70 and a half. You don't have a choice whether you need the money or not. The government says you must start your required minimum distribution. We've all heard the term, RMDs. So what can you do if you don't need that money? Typically, somebody would take whatever they need to out of the IRA, and maybe they'll put it in the bank. But I'm going to give you an example of a gentleman who is 69 years old. And this gentleman had amassed a sizable IRA, $4 million. And at the end of the day, you're going to hear how it became $14 million.
Okay, so 4 million becomes 14 million. Sounds like alchemy, which is like turning lead into gold. Not that 4 million is lead.
No, 4 million is not. And as they say, chopped liver. But here's how it works. The 69-year-old man, his IRA was earning approximately 6%. That was $240,000 of interest annually. Now, the distribution that was required was not $240,000. It was a much lesser number. But what was discussed was, let's move away from what the government tables are as far as RMD. Let's take out the interest that you're making each year. Why? This way you still have your principal, maintain the $4 million. If you ever needed the money, which he won't, but nevertheless he knows the principal is there. Number two, by taking the $240,000 out, he will pay income taxes. That will leave him with $140,000 after those taxes are paid. Now listen closely to this. If he takes that $140,000 and gifts it to an irrevocable life insurance trust and has the trust purchase a life insurance policy on his wife, his health was not good. She was 64 years old. His family would have approximately $10 million of death benefit when she passes away. Now that is $10 million tax-free for his children without touching the $4 million principal that's in the IRA.
Wow.
Now, there's something that's even more. in order to be sure that the remaining $4 million principal in that IRA would not be subject to income or estate taxes. Because remember something, they have a choice. The $4 million in the IRA created the $240,000 a year, which after tax was $140,000 a year. The money was gifted to their irrevocable trust. A policy on his wife was purchased in the amount of $10 million. The kids are covered. They received $10 million tax-free. He could leave the extra $4 million in the IRA to the kids, but what's the point? After income and estate taxes, they may be left with $1.3 million. So, what does he do to avoid the income and estate tax? He sets up a private foundation so that when he and his wife pass away, the entire principal, $4 million, would go to his foundation so that there would be no income tax or no estate tax. That means $10 million for his kids through the insurance, $4 million for his charity. Now, had he not used the insurance as I described, what do you think his $4 million IRA would have to grow to in order for it to net the same $14 million that I created from day one?
I don't know.
You don't know. No one does. Why? Because the leverage is so phenomenal. It would have to grow to approximately $45 million so that after all income and estate tax costs, it's down to the same $14 million that I created from day one. And again, how was it done? Just by taking the distribution from his IRA on what he's making each year,
Right.
paying the income tax, and buying a life insurance policy within an irrevocable trust.
And that's very creative. And I think we have to be creative when you're talking about wealth and trying to grow it. Now, Howard, you mentioned to me before the program that people can set up their own inheritance. How does that work?
Well, absolutely, Michelle. And this is for younger people. When I say younger people, people who still have parents living that are in good health. So let me give you an example. What does it mean to create your own inheritance? Well, it's something that I call the 401k plan. Now,
Kaye, like
exactly.
Howard Kaye.
401 Kaye. And what this plan does is it allows you to use life insurance for your own retirement, and at the same time it ensures the parents, your parents, it gives them insurance for your benefit, which many people like to know that their children will receive it,
Right.
but there's no financial burden. Why? Because the kids are going to pay for it. So let me give you a quick example. A gentleman who was 45 years of age says to me he's putting away $20,000 a year into some fund. And he says he plans on retiring in 25 years, the age of 70. I asked him, how much money does he believe that he will have at that age? He looked at me with this inquisitive look. How would I know, Howard? All I can go by is they showed me if I make 10%, 8%, 12%. Well, after we got through all of that nonsense, because who makes a steady rate like that each year, I said to him, how about this? You take $10,000 a year and do it your way, and you give me $10,000 a year. And I will say that you will have approximately $700,000 at some point during your retirement from my $10,000 a year. He looks at me and says, well, how can that be? I said, how old are your parents? He said, 69 years of age. I said, well, guess what? You can purchase a $700,000 life insurance policy on your two parents, last to die policy, who are 69 years of age. Now, you will pay $10,000 a year for this. 25 years from now, when you retire, God willing they're here, but at 94, they've lived past their life expectancy.
Right.
So in theory, they're not supposed to be. But if, like I said, God willing, they're here, the fortune that you've made with your $10,000 a year, the way you invest it, start living off of it, because it's a matter of time before your parents will ultimately pass away, and that $700,000 tax-free will come in. On the other hand, if, God forbid, your parents should predecease or pass away early, you weren't looking for this, but it was a windfall, and that $700,000 came in completely tax-free. So here was the bottom line. Could you take $10,000 a year and over time turn that into $700,000 completely tax-free? I don't believe he can.
Right.
He didn't believe he could, and that is why the life insurance is used as a diversified part of his overall portfolio. He still got to play the market the way he wanted, but he also secured himself through the 401k AYE plan, a method of creating his own inheritance.
This is great. Now, I know you have a lot more to tell us about creating wealth and preserving it, but we're out of time, so we'll have to wait until next week. But thank you so much for being with us today. And let me remind our viewers, for more information, 561-417-5883 and online at insurewealthtv.com. See you all again next Saturday at 5:30. So long.